Welcome out to another edition of the Trading Justice podcast here with my brother Matt. Listen, we got some very major storylines to break down for you. We have a tariff that the markets are reacting favorably to for good reason. We have earnings, particularly tech earnings. This is a major storyline in the market, one you should not ignore. We have gold miners, well, basically saying, hey, we got one of the best fundamental cases we've had maybe ever. We got a big week ahead. We're going to break it all down. What was, what's coming, break it all down for you. Matt, how are you doing?
I'm doing fantastic. I'm excited to be here for another edition of the pod and looking forward to a conversation on all things market related here today. No doubt about that.
Yeah, Matt, and you did a great job on the newsletter. Just talk really briefly about it.
Every single week in the newsletter, there's 5 sections in the newsletter. Section number 1 is going to be the technical update. So five articles, basically technical analysis, macro earnings, and then we get into the sector rankings, then we get into the global markets and the economics of the scenario as well. So we try to make our community completely full understanding of the entire environment, from technicals to behaviorals to fundamentals in the newsletter. And there's also 3 videos there as well. Every single week in the technical update, it literally is an ongoing update. Every single week, I just kind of continue where the conversation left off last week. And in the last, 4 weeks, it's kind of been a very it's been a compelling ongoing saga of bearish retracements, deeper bearish retracements, V-shaped recoveries. What type of reversal are we going to get? Trying to help our community understand the entire technical environment. And what I kind of talked about this week in the newsletter is the conversation on the bear stop out pattern. And the bear stop out pattern has been a dominant case study that we have anchored against in this market correction. And if you don't know what the bear stop out pattern is, well, number one, it is the first bullish pattern within the construct of a V-shaped reversal, and it's the V-shaped reversal which we are currently tracking in the marketplace. There's 3 reversals: W, head and shoulders, and the V-shape which has bear stop out analysis. And I took a moment to kind of explain the bear stop out analysis while using the current S&P 500 chart as the case study. And so if you want to understand what the bear stop out analysis is, kind of how the market is performing in comparison to the historical case studies of the trade war number 1 and the pandemic, which is kind of the pricing we're tracking here, well, that's what I wrote about in the technical article. And I'm just going to tell you right now, we've been anchoring against this bear stop out pattern for about 2 weeks now. It's taken a little bit of time to develop, but at the end of the day, Mark, the best quality patterns do take some time to develop because there's pivot points in those. And right now we got a pretty compelling technical pattern. And honestly, Chucky, I know there's a lot to talk about this week.
There really is.
How the market behaves around those macro headlines, earnings, tariffs, and so on and so forth is going to play a large role in whether or not we break this 550 level. But the 550 level in the S&P 500, the spiders, that is the level. That's the bear stop out level. And it's going to be interesting to see what kind of patterns we can get at that level this week.
Yeah, absolutely. And one of the reasons that we are talking about bear stop out, a break of resistance, the 50-day is going to come down really close there. It's going to make for some really interesting technical dynamics. Be sure to check out Tackle Today every day, or our pro member community will get a heavy dose of technical analysis in our lounge and in all of our programming. But Matt, one of the reasons that we are talking bear stop out and a break of resistance instead of a double bottom is a change in dialogue and tone on tariffs this week, right? If you didn't have that change, we could be talking S&P 500 instead of 550. I mean, that's a 10% swing just on this major narrative. And we had some real, concerted.
We could easily been talking about 500 this week. Easily.
Like it's easily. Like if we do not have a change in tone.
In fact, that's what was happening on Monday. Like, yep. That's exactly what was transpiring. And then we started seeing the change in that tone. So just very quickly, how we're going to handle this market skyline conversation is we're going to do something similar to what we do in the morning action video every single day. Whereas we lay out the top 5 stories in the morning action every single day. So definitely check that out. But in this podcast this week, we're going to kind of test that same type of thing. We're going to be looking at the 5 major stories, but from an overall week to week perspective. And that's basically how we're going to handle this. I just wanted to make sure that as we go on this conversation that people understand what we're doing here.
Yeah. And so, Monday market's grumpy, looking at maybe double bottom analysis or a higher, level right above that in the 500 range. But then starting on Tuesday, heading into the market, Matt, we have a change in tone on tariffs. First of all, already a forgotten story is Vice President Vance was over in India. They were starting to talk some, hey, we're making progress. We're holding hands. We're going to get a trade deal here. A lot of little positive. That kind of got some, overnight action into Tuesday going. But that's when the heavy news flow started over the next couple of days. Treasury Secretary Bessent, who is doing his best impersonation of Janet Yellen being the bull's best friend, came out and discussed that, listen, this trade war with China is not sustainable. There's a deal to be had. Market really liked on Tuesday that language, liked even more heading into Wednesday, coupled Trump coming out saying he wasn't going to fire Powell, but in particularly talking a little softer on China, saying like, listen, there's a deal to be had here. We are going to lower tariffs eventually. It's not going to be anywhere near, we all know how Trump talks. It was very, like, hey, there's a deal to be made here. It wasn't the hateful, antagonistic, rhetoric out of Bessent or Trump. And then that just kind of continued through the rest of the week. You got a little bit of small things from China as well. They lowered the tariffs on a couple select goods. It was confirmed. Remember that a couple weeks ago when we had all of those tech exemptions? Mm-hmm. It was confirmed by China that a lot of those products weren't facing tariffs. And so basically throughout the week, you got a steady dose of de-escalation type rhetoric out of the administration, matched a little bit by China. Market took that momentum, and here we are at 550 instead of 500, just on that positive rhetoric. It was a big deal during the market. And Matt, one of my biggest takeaways, and the other one's going to be when we talk about earnings this week, was that as long as you hear this de-escalation type language, we'll let the technicals tell us how much strength it has upward and momentum. But I felt so much more confident about naked puts and credits underneath and the stability of the market as long as those worst case scenarios are off the table. What was your take on that? I think
that's what kind of the way the tariff conversation is getting paid in is that from Tuesday on, it was positive. That wasn't my read. Although my read was the Tuesday information of JD Vance in India and kind of the positive reaction to it. They haven't announced the structure of that trade deal, but that is happening, and we all kind of know that's happening. And so on Tuesday, you had those two positive stories. You had obviously JD Vance in India and the ongoing talks there and what that represents to kind of the broader trade conversation. And then you had Trump seemingly talk a little bit softer language on China, including its conversation on J-Powell, right? From that Tuesday on, Mark, I would actually describe the Wednesday conversation, the Thursday conversation, the Friday conversation as a little bit aggressive on both sides of the conversation on the trade war conversation from the US and from China. However, the market didn't care about that because on Tuesday they kind of formulated the opinion that, okay, there's going to be a lot of chatter, there's going to be a lot of talk, there's going to be some aggressive, some not, but it does feel like there is a catalyst change here on how the US is approaching this trade conversation. And so the market did discount some of the aggressive language that we saw on Wednesday, Thursday, and Friday, but seemingly that Tuesday was a catalyst change, no doubt about that. And you mentioned that you felt a little bit comfortable on the naked put side of the equation. The only thing I'll say about that is, Mark, that could be some alleviation on the trade war, and we're seeing a little bit less volatility. The VIX is obviously came down as the market is going back up. VIX at 25 here underneath that very important 30 handle. And so we're obviously seeing volatility come down, Mark, but you're also seeing the first increase in support against the backdrop of this bearish trend in the course of the last 2 months. So ever since we started this market correction conversation that was dominant around the tariff conversation, we have not seen an increase in support level. You saw leg down, bearish retracement, violation of that support level, leg down, deeper bearish retracement. And the very second you get into a deeper bearish retracement conversation is the very second you're going to start thinking about bear stop out patterns. And bear stop out patterns usually have a deeper retracement. And a lot of times they'll see an increase in support because of that deeper retracement. And that's exactly what occurred here. 2 weeks ago, you had that deeper retracement. Last week, coming into that Monday, you got caught on a shallow pullback. So, and I had Team Tackle for the last 3 weeks, like every week in the lounge, basically chant bearish downtrend, deeper retracement, shallow pullback, breakout. Bearish downtrend, deeper retracement, shallow pullback, breakout. For 3 weeks, I've been having the team chant that because I want it in the back of their head what that pattern is. And that is the bear stop out pattern. Bearish downtrend, deeper retracement, shallow pullback, and then that increase in support on the shallow pullback. This right here, when it starts to show a trigger down to the low, once it increases, as we saw on Tuesday, Monday and Tuesday this week, that gives the market just an edge. And the moment that support increased, Mark, you started seeing how intraday the market started behaving. We started seeing more consistency on the bull side of the equation than we've seen in a very long time. And so when you're talking about the fundamental condition, the behavioral condition, the economic condition, the trade condition, all of these macro conversations that are happening, well, shockingly, the very moment we got an elevated support level, the bulls started having more consistency on every single time frame. And so technically here, I'm always going to say that it's important to understand the macro side of the equation. As a top-down analyst, you want to understand the macro, because if you get the macro right, you're going to get a lot of the micro right as well. But at the end of the day, Mark, however we're having that conversation, I think the most important data point this week was not the trade side of the equation, was not the earnings side of the equation, which are vitally important to understand. But because of those conversations, you have the first increase in support going into a potential breakout. So we had the first elevated increase of support in weeks and weeks and weeks. Do we get the first breakout that we've had in weeks and weeks and weeks? And the last thing I'll say is it's been an improving condition for the bulls, but that's because they had so much deterioration recently. And so it's going to be very interesting to see if the market can legitimately show some bullish upward moment in strength, given the fact that, yeah, there was an improving conversation on trade last week, but Mark, we're not out of the woods there. by a long ways, we're not.
And that's the biggest where it is, like, because some individuals out there are calling this an administration pivot. People love in the finance community to use the word pivot to describe change in policy. Like, yeah, it's just a very popular word because because it's a way to communicate with each other.
It's just a change in direction. That's it. Like,
and so one of the questions that I have, that I don't have the answer, I don't think anyone around the world has the answer. Is this an actual pivot? Is this an actual change in rhetoric, or are we going to return to increased volatility? And that's
I think you have.
What's your take on that?
I think you have to include some good old-fashioned political behavioral analysis in that question, because I do think how we just got a latest batch of polls this morning, and they were not very positive for the president. And so it's going to be increasingly difficult for the president to complete this trade side of the negotiation that could take a long time if the American populace doesn't support it. And we are starting to see that a little bit. And so to me, I don't know. I don't know if this is a true pivot or not. I don't know if it's just part of the negotiation. But I do believe that the worst case scenarios have been alleviated.
Yes, and that's my big takeaway.
And that's my big takeaway as well. It's like, I don't know if the president's going to change his mind on some aspect of the trade deal. I mean, in negotiations, things change. They happen. You have to respond and react to the analysis that is coming into you on negotiations. And so things are going to change there. Does that mean there's a pivot? I just think that there's not a commitment here from a U.S. perspective to the difficulty that you would have to see to achieve what you're trying to achieve from a totality of trade deal perspective. And so I think that's going to be a little bit difficult. And so I do see the alleviation of worst case scenarios this week. I do think that it's going to be very important to get this conversation out of the realm of hypotheticals and over the, like, don't get me wrong, Mark, the market's discounted some of the negativity in the trade conversation over the last few trading sessions. It won't discount that if it continues.
Yes.
Don't get me wrong. The trade rhetoric and how it has shifted a little bit from a negative to a positive in terms of just kind of the rhetoric perspective, that is certainly a positive change. It's important for us to talk to trade partners in a very, respectful manner. But at the end of the day, I don't know. I don't know for certain if it is a true pivot or not. I just think if there is a pivot, the pivot is to worst case scenarios. They're not willing to hold through certain volatility in the market. And I think that has been very telling to the market. And so are they committed from a language perspective? Maybe, maybe not. But there are certain levels in the bond market that they will not test. And I think that is the Treasury Secretary Bessent's kind of the way he's thinking about it is, yeah, we want to get trade deals done, but we can't ruin the U.S. economic advantage just to get some trade deals done. We want to get trade deals done. We want to bring manufacturing home. We want to make sure that we control as much of the supply chain as we can. But at the end of the day, are we willing to risk X, Y, Z to achieve that? And that's what I think was alleviated this week was worst case scenarios. And that was enough to get the market to get back up, get the market back to resistance. Is that enough to get the market to break out? I don't think so. I think they're going to have to see some more positive change.
Yeah, I know I will buy dips if they're deeper, and I'll play strength if we get patterns. That's how I'm approaching the market. I think that's a good, mix.
Yeah, I would agree. If you break out on bear stop out, that's a trader's conversation, no doubt about that. If you double bottom, that's a longer term investor conversation. So yeah, I see it very similar.
Yeah, and there's a lot of interesting other things going on. Obviously, I think we're both on the page that as long as there isn't a big event, markets are in the mood to move on from the tariff conversation.
I know I am.
like as long as there aren't big events, people can talk and they can chitter and
Coach Freight was excited about earnings season.
And so like, as long as, obviously we'll all be keeping an eye to see if there are any of those big, moves, either a cutting of tariffs or something negative. Either way, we'll adjust accordingly. But Matt, we are in the heart of earnings season, and the next three stories that we want to talk about are all earnings related. And some, I want to just jump right into the tech earnings because I think but we're going to set the stage and talk about that in a minute. Just give us a brief earnings update overall where we're at right now, as we're how many companies in to the S&P 500 right now at this point?
Only about 36% in. So
about a third in.
It feels more and it kind of feels less simultaneously. But we're about 33% in. This week is the big week. You get another like 177 companies this week out of the S&P 500. So we're talking about basically all the companies that are reported so far. We're going to double that this week. This is the big week in earnings. You got Max 7 companies, you got Meta, you got Microsoft, you got Apple, you got even off the beaten path, you got Eli Lilly out there, you got Catalyst stocks and absolutely everything out there this week. And so it's going to be a fantastic week from an earnings perspective. Earnings season itself has been kind of shoved in the back door a little bit here. It's been a secondary part of the analysis. And obviously, that's to be understood when you're having a tariff conversation, a major trade war conversation, and those things are seemingly updated all the time, every single day. And so earnings has taken a back seat. But one thing I did start to see, Mark, as the market from Tuesday on this previous week, the market started treating earnings more normal.
Yeah, it did.
And what I mean by that is up until Tuesday of this week, for the first few weeks of earnings season, whatever the market was doing that day, those companies were doing that reported. It did not matter. If you lowered guidance and the market was up, you got a slight bid. If you increased guidance, very rare, but if you did and the market was down, you went down. Like the market was just so heavily influencing everything out there in the market. That has started to change. And as that is starting to change, two things. Number one, that tells me that the market is starting to discount some of the tariff information that's coming into the market, meaning they're not pricing in every single headline that is coming into the market. And so we're moving away from that conversation just a little bit. And number two, as earnings comes back and we start to see the influence of what these companies are saying, we're also starting to see separation from a sector perspective as well. So when you look at sectors before this week, for example, and you would go down the list, they were all kind of doing the same thing. But now you're starting to see a little bit of separation on the sector side of the equation. And I fully anticipate that to continue this week as well. In fact, I think one of the most important things that we're going to be talking about in next week's newsletter is probably sector rankings. And that hasn't been an interesting part of our scout and report meeting in recent history because everything's kind of been doing whatever the market was doing. So those 2 points on earnings season. Now, earnings season also had a really good week for the bulls narrative. For the first 2 weeks of earnings season, we started blended growth at 7.1%. We were kind of the first 2 weeks kind of in that range, 7.1, 7.2, 7.1. There was no sizable movement on the growth side of the equation, which is what I look at blended growth for. It is a EPS growth narrative. There's a growth conversation in the market regarding the concern about EPS growth in the future. Well, we were stuck at that 7% for the first 2 weeks, Mark. Now we're at 10.1%. So we actually got 3-point bump last week on earnings growth. And we had some really good reports that we'll talk about here in just a moment. But there were some really good reports. ServiceNow was a good report. Google was a standout on EPS beat percentage. They were expecting 280. They came in at 281, for example. And so you saw a sizable increase in blended growth to above the 10%. This week is equally important from a growth narrative. If you want to see whether this market is actually going to break out and run in bear stomp out pattern, well, to me, it's not going to be on what anybody says on the tariff side this week. I do think we're going to get some updates coming out of Rome, but I don't think that's going to be the number one major market driver this week. I think that's going to be the number one major market driver in the futures open later on today and in the cash open tomorrow. But from that point on, I do think it's going to be an earnings.
Yeah, I'm with you 100%. I think for the first time in over a month, tariffs are not the main driver. I think it's earnings. I think it's the economy.
I think it's the earnings data and the economic data that's coming in this week. I would agree with that. EPS beats, just kind of let me give you some raw numbers here, Mark. The 5-year average on EPS beats 77%. We're currently coming in at 79%. The veracity of the beat has been a little bit of a concern for me. But we last week, we saw that elevated this week as well. 63% of companies are beating the revenue handle, which is underneath your 5 and your 10, but pretty decent for the last couple of years, to be perfectly honest. When you're looking at the sectors here, comm services, technology, and finance are the 3 sectors that stand out in earnings season so far. 2 laggards that stand out, industrials and basic materials.
I don't know. I mean, you're my earnings guy. And so I take the raw information. I make notes on all that.
Finance, tech, comms. Those are your 3 big ones out of earnings that have had some separation. Google had a sizable impact, for example, on communications. We've seen from Taiwan Semiconductor to Lam Research in the tech space. ServiceNow in the tech space was really good. A lot of thought on AI 3.0 here. Let's see.
Well, and let's talk about that, and we'll talk about some of the commodity earnings in a second. Because, when I walked away, and I was talking to someone just briefly, a non-trader, and they asked me basically what's going on in the market. And I was like, well, I don't have all the answers, but I know two things. And then I talked about, the tariff. I was like, it seems like some of the worst case scenarios. And the other thing I talked about is like the AI trade and technology earnings have been really, really, really solid. You and I made a comment in the podcast last week, bookmark Taiwan Semiconductors earnings. And that was not this last week, but the week before. They were outstanding. They showed that demand for AI was alive and well. We got notes this week out of data centers where both Amazon and other major players talked about, NVIDIA, I think it was Amazon and
NVIDIA, Meta. Yeah.
We're talking about how demand for AI data centers is as robust as it has ever been. And in a busy week, that was a sneaky important story because, one of the major negative tech narratives this year has been that,
yeah, that's the thing about the macro conversation is these micro themes that are kind of underneath the surface. They're hidden from the general public view right now.
And remember, listen,
that's why we said bookmark Taiwan.
2 months ago, nobody was talking about tariffs. When that sell-off started in tech, that was not a tariff-induced sell-off. That was a DeepSeek and CapEx.
CapEx.
And so that
concern of the hyperscalers pulling back because of Microsoft.
Yeah, and so you got reports out from 2 weeks ago. Taiwan, you have the major players talk about that. And then when we looked at Google didn't cut their CapEx spending at all, right? And so like in the midst of all the tariffs, this and China, that, we've had a really good couple weeks on the AI narrative. Not a shock to us at Tackle Trading, who have been like very, not a shock to us at all. But we've got confirmation that AI spend is alive and well. And the raw numbers in the AI space technology really stands out. And so I like what you said a few minutes ago about how, listen, sector rankings and looking at sectors hasn't been a big deal recently because the market's just up and down, whatever, and that just taking everything with it.
When defensive and aggressive all perform similar, you're not having an earnings saga.
But you have had a really good couple weeks on tech earnings, tech narrative.
That's been shielded because tech's very sensitive.
And that I think is the biggest story from the last couple of weeks
on the trade war. I think you're in front of wave number.
And let's not forget, 2 Fridays ago, there was all of those exemptions that were confirmed by China on technology products. The tech feels like it leads here. It feels like pretty easy call.
If the market does confirm that bear stomp out and we see the pandemic pricing play out in 2025, yeah, I would absolutely agree with that. I obviously think you have to take into account the macro, but at the end of the day, Mark, if macro...
the macro can blow it all up if it's that bad of news.
If it doesn't, which most of the time market doesn't, right? The high percentage...
Most of the time the worst case scenarios do not play out.
Okay, and we saw a lot of alleviation on worst case scenarios. For example, Mark, did you see everybody and their dog act like the reserve was ending last week? Or was that put in the backseat a little bit? That was put in the backseat a little bit. And so it'll be interesting to watch that play out. But yeah, Mark, as underneath the surface, I do think you have to.
Yeah. I think you have to understand this because it's not a perfect market. You can have a headline blow up a bullish trade.
Oh, we can talk about this.
You have to accept it. Like you just have to put on your big boy
volatility playbook.
Big boy, girl, and it's a really good technology argument right now.
Well, let's make the technology argument then. In terms of the tech argument, you're talking about from an earnings perspective. Earnings season has been good, but it hasn't been a standout. We've seen a lot of misses in energy, a lot of misses in cyclical, a lot of misses in industrial. The defensive areas of the market have not been standouts on earnings. The standouts were
Procter and Gamble was not good. Like
healthcare has been downright bad, good. Honestly. But even out of healthcare, I haven't seen a lot of utility companies or REITs or whatnot. I just haven't seen a lot of companies show any degree of umpty here on the earnings side, except tech. When I'm
Except
talking about
tech.
that blended growth number
This is
going
a
up 3
freaking
points
trader's
this
market
week,
right now.
that was Google, Mark. That was the aggressive areas of the market that saw blended growth go from 7% to 10% this week. And if it achieves 12% this week, it's going to be on the backs of the Max 7. And so for the first time in 6 weeks, we saw the Max 7 lead last week. They led based on Google and some of the earnings conversation that is happening out there. And so when I'm looking at kind of in story number 3 here, on the AI earnings side of the equation and tech itself, you can label it tech. I know. What I'm seeing is AI, not tech. I'm seeing AI. AI impacts more things than just tech. Obviously, it has a big impact on tech, but it does. The AI trade has healthcare companies in it, Mark. The AI trade has REITs in it, for example. And so I don't know if it's tech or if we're seeing AI start to go wave 3 right now. But let's look at some of those AI relatable names right now. Google had a standout beat last week, 280 against $2.
I don't want to use the term flawless, but like in my stated a holiday in earnings analysis, level of knowledge I have, is like, dang, I can't find any flaws in that.
They announced a $70 billion stock buyback program. They announced a 5% dividend increase. That's on backs of the 80-cent beat on EPS. It's one of the better reports, and it had a very similar impact on Friday that we saw at a Taiwan Semiconductor, but it's above that resistance level. ServiceNow had a wonderful beat last week. Slight beat on the EPS, slight beat on the revenue, but they also had a guidance report that was a standout. And that's one thing I started seeing late this week after that Tuesday, Mark, kind of that Tuesday pivot, when the market seemingly moved on a little bit, I do mean a tiny bit, from tariffs into earnings, is we started seeing beats get rewarded. We started seeing misses get punished. We started seeing, how many times in the first 3 weeks of earnings season have you heard me say, guidance doesn't matter right now? Guidance doesn't matter right now. We're not seeing any overall impact on guidance. Well, that started mattering this week. We started seeing separation on that side of the equation. ServiceNow was an example of that. ISRG was an example of that. ISRG has a beautiful reversal on the head and shoulders reversal, by the way, after post earnings. So keep an eye on ISRG. I thought Lam Research was a standout. Lam Research, I know there's a lot of people at Tackle looking at Lam Research right now. Great fundamentals, obviously caught up in a lot of the noise in the marketplace right now, and they are starting to break back up above a very important resistance handle right there at 70. The only one that I would say out of the AI trade last week, and I'm talking about companies that live on the AI gold rush, is Tesla, who Max 7 company. Tesla here had the worst report of all of them last week. There was not a company that had a worse report than Tesla last week. It was the equivalent of Meta in 2022, when they just had a horrific EPS miss, a bad revenue miss, guidance was slashed. They were spending way too much money on R&D. They were burning money for Zuckerberg's personal pet projects, I would say. And at Zuckerberg at the end of 22 said, we're done with all of that year of efficiency. Let's giddy up and go. And despite that gap down on that earnings report, Mark, Meta had that next year one of the best years we've ever seen of any company out there. Can Tesla repeat that is a question. They had a horrific earnings report. They had a terrible miss on EPS. EPS was expected at 54 cents. Mark, they came in at 13.
It was garbage.
It was absolutely garbage. Year over year was a terrible revenue handle. Vehicles delivered was down. And yet Tesla, from that report, is up 50 points against a 240 handle. It's up about 20%, kissing into a reversal. And so we're starting to see things play out. Tesla's unique because it's kind of running on the listen, we don't care what happened in the future. Elon hasn't been at the company. Elon's going to now be at the company. Let's see what he can do there. That's kind of what's happening here on Tesla. Does it get a little bit of a mini Starbucks love? You remember when they ripped off their fired their CEO last year and got that 20%?
You're the only person in the world that is going to compare Starbucks to Tesla, but it's a great analogy, right? It was like, no, like Starbucks went through a couple quarters where it's like the numbers are garbage, but investors look past it and said, listen, this is a quality company, right? They're going through changes. They'll get it right. And they look past the numbers.
Out of earnings last week, I felt like in story number 3 here, I felt like it was the AI relatable names that had the best bullish pricing from a totality of earnings perspective last week. Although I do think story number 4 is close.
Yeah, like, listen, and so, like, when I walk away from this week, I'm like, yes, can something blow up a trade, blow up a position, put up thing? I love tech. I love it a lot. I think it's a leadership as long as there isn't major escalation with China that impacts, right? But that's the kind of what we got this week. Another area that is hard not to love are gold miners, Matt. We saw that Newmont Mining.
That's story number 4.
Yeah, we're going to transition into.
Let's make sure to announce we're moving on though.
Okay, we're moving on to story number 4.
People like bookmarks in YouTube
videos.
They do.
Well, we all like a little bit of structure in our life.
They don't love run-on paragraphs.
This is absolutely true. But in transitioning from areas,
I don't know if you've caught this, but I have hinted 5 times in this podcast for you to do that. I'm glad you finally caught after I directed it.
Listen, but people like
that was just so funny to me, by the way.
Your brain sometimes.
I know.
Your brain sometimes. Well, listen, my transition is people like good quality fundamentals, and we're seeing a lot of that at reasonable valuation in technology. Matt, it is really hard in story number 4 to not like the fundamentals of some of the quality gold mining companies. Listen, this is not a complicated story. Operations for things like Newmont Mining, they cost about the same. They're running the same things, and gold goes up 10, 15, 20, 25, 30% over the course of a year. All of a sudden, when those companies report, surprisingly, they have fantastic numbers. This is not a terribly complicated story to understand. Newmont Mining reports earnings, and it is absolutely fantastic, right? Profitability, total revenue, right? And as long as gold, remains elevated, gold doesn't even, this is the old oil argument. Like, oil doesn't have to go up for these companies to make money and get healthy and all that. It just has to just kind of be where it's at, right? And
well, that's if oil is already up,
but gold miners, it was a very impressive report. Matt, talk about it.
Newmont Mining, I thought, had a standout report this week. They came out with just a dominant EPS handle, $1.25 mark. Expectation was 84 cents. So we're talking about a big time beat there on the EPS side of the equation. Revenue was above expectation as well. They didn't provide guidance, but I mean, in general, what you did see out of Newmont Mining here, and I wanted to go out to a weekly time frame to kind of show, the market this year on the gold stocks have been absolutely lights out all year long. Newmont Mining up from $40 up to, $54 right now. But when you go out to GDX and you're looking at the gold miners here, GDX is up from a opening yearly print at 35 all the way dinged 53 here this week. I do have it as generally overextended, the gold miners, and looking for some pattern development in general on this bullish retracement. Looking pretty good on the bullish retracement. We just, obviously are tracking that from the depth of the retracement perspective. I thought Newmont was a standout. I thought other gold stocks this season have been a standout as well. And the simple reality is there's something we are anchoring against, and it is that gold catch-up story. Mark, when you look at the overall pricing of gold is up. When you look at GC, up. We deemed 3,500 this week. We're currently at 3,300. These companies, Mark, from what they're reporting on, was pricing when they were drilling for gold at 2,600 and 2,700. We're currently at 33. I believe in the gold miner catch-up story. I believed in it for all year long. I don't believe this is going to change. I think it's the only question is how strategically do you play the catch-up story? And for me, strategically playing that catch-up story is currently I'm looking at the pullback and seeing if we can get a little bit of confirmation on the gold miner pullback in general. But if you're not looking at the gold miners right now, like again, you are looking late stage trend from a short-term trend perspective, but I do believe in the catch-up story long term here.
Yeah, I mean, this is one of these where when technicals and fundamentals intersect, right? When I see a good technical pattern on GDX, if it pops up, right, I have the confidence of the fundamentals in the background. And I love it when you can match those two up in trading.
Yeah, and the only thing I'll say to the rest of the commodity space that reported this week is the biggest difference between Newmont Mining and Schlumberger, for example, is the price of their underlying commodity. Schlumberger's underlying commodity is oil. Oil has not been doing very good. Schlumberger had a miss here this week. When you look at FCX, for example, FCX Southern Copper, I think they have really compelling technical conversations coming from the low point. I think they have compelling fundamental conversations coming from the low point, but from an earnings perspective, they don't have the size of the beats that those gold stocks are having right now. FCX came out with I want to say FCX actually came in line. Southern Copper came in with a slight beat, and so the gold stocks out of the commodity landscape are obviously reporting the best right now, given what their underlying commodity is doing. Southern Copper, FCX look pretty decent coming from the low point as well. Those oil stocks, Schlumberger, they're going to need to see a little bit more.
Yeah, absolutely. You know, and our fifth story,
Look at that. Look at that. Look at organization. Look at organization. This is amazing. No run-on sentence. Organization.
And our fifth story,
a bookmark. This is awesome.
Listen, we talked a lot about earnings. We both, you know, if listening to this podcast, obviously we feel outside of escalation. We're going to move on from tariffs quite a bit into both earnings, right? Separation in areas of the market. But a big thing, Matt, this week is the mega lineup of economic data that we have coming at us. Listen, it's easy to forget that part of the conversation and the worries associated with tariffs in general, the economy as a whole, is will we not have a recession, right? That's kind of the fundamental narrative behind it. Well, Matt, like we have a massive week of economic data. We have the first quarter, and remember, Atlanta Now GDP at one point in the first quarter printed, you know, a negative number. They've revised that up to not a robust number, though, right? Concerned that the economy slowed down materially in the first quarter. That is something that we'll get a little bit of data on Wednesday. On Wednesday, also, for some reason, they have moved the core PCE price index, the Fed's preferred inflationary measure. But as my brother liked to say, the market's third favorite. So for some reason, they moved that into this week. It is normally not on labor market week, but they moved it into this week. You also have, manufacturing data on Thursday, and then you have unemployment data all week long. Matt, there is a very good chance, you play out the different scenarios. Let's say GDP comes in better than expected. It's not expected to do much, 0.4%.
That is a cut from 2 months ago.
That is 0.4%. That is the lowest projection I can remember in a long time. I can't even remember the last time. Maybe COVID, right? I don't think we had those bad numbers in 2022 as far as projection.
Not in projections. Everybody thought they were going to be worse, but it did.
They thought, but they never got to the projections. So that's a really low bar. You have anticipation of inflation coming down a little bit.
Jobless, it's a low bar that everybody feels is going to miss as well. So if a beat can be a positive here.
And so it's going to be really interesting what the narratives in the market are at the end of the week. Do you see an economy that did better in the first quarter and does better in labor? If you do, if you see decent economic data coupled with tech earnings and maybe some de-escalation, that really takes some bearish steam out of a lot of the arguments. On the flip side, right, if that number does come in lower, right, you see jobless, right, needless to say, this is a massive week on the. That's a lot of red.
Yeah, I think it's a big
on
week, and the reason I think it's a big week is the economic data that has been concerning has been the soft economic data regarding the consumer. What we have not seen is that soft economic data lead into the hard economic data from an actual economics perspective. And this is kind of that first week you're going to have an opportunity to see that out of the advanced GDP report, which is the first of the series of 3 GDP reports, and obviously the most important one. You also get the core PCE prices index, which is the Fed's preferred gauge. I typically do believe that is the fourth most important inflation.
Do you think they moved it on GDP day because they knew GDP was going to come in weak and they wanted some positive inflationary data? Like it just doesn't happen.
They probably will get some of that, but there's other things in the GDP that can be parsed out for that. But no, I do not believe there is a conspiracy theory that they moved the PCE price index, the fourth major inflationary index, into the advanced GDP, the first most important economic report. And so, no, I don't. I just think we had a day where we didn't have any reports last week or 2 weeks ago, and that has to be caught up on the calendar. So
I like my conspiracy theory better.
I like your conspiracy theory more too, by the way. What do you feel is the most important report this week?
Payrolls always is, right? But
labor market.
GDP, because of the narrative, right? Because it was such a big deal.
Down to 0.4. Yeah,
it was such a big deal, like all quarter long with drama on the Atlanta Now GDP. And it is a shocking number to see 0.4%, right? And so if that comes in at 0.2%, right, or 0.1% or something like that, that's a narrative former. But payrolls always will be number one, because as long as people are getting jobs, it's hard to make the big recessionary claim, have like any real teeth to it. So, but two big reports.
Yeah, right? I think labor's really big this week. And I also think the advanced GDP report is pretty important this week too.
And so it's going to be like, we got a lot of narratives in flux. We got a lot of narratives forming. This is going to be one of those weeks. You just want to be paying attention, right? Coupled with technical
this is analysis. A catalyst week. It absolutely is a
catalyst week.
Technically, you're sitting at resistance in the bear stop out pattern. Earnings wise, you're in front of the largest week in earnings season and probably the most important week in earnings season. Economically, this is the first opportunity we have a chance to see how the concerning consumer confidence numbers and soft data in general has an impact on the macro side of the equation from a hard data perspective. These are catalyst weeks. There is no doubt about that from every single level of the market. I feel this is a extremely important week to understand. And, that's why we wanted to talk about it the way we did this week, just to make sure our community is fully apprised of everything that's happening in the market this week.
I got a couple questions to close out the show. We like to do Coach's Corner. One of the things we do with our pro community, it is one of the highlights we have every single day, is we hold a traders lounge in our pro community and we answer questions. We call it team time, where basically, one of our pro members can come ask questions on a trade management, a chart, general education. They can ask whatever they want. This is a little abbreviated version of that, taken from questions that we've had from students or that were sent in directly to the podcast. You ready to do our final segment, Coach's Corner, Matthew, Todd, Justice?
Yeah.
All right. Question number one. I am concerned about my hedges. Now, we got a couple versions of this, which upward price movement, when people playing it, right? Volatility playbook, people, doing responsible things. This specific question is kind of accumulation of a few different questions that we had. I'm concerned about my hedges. I bought several puts on core positions during the volatility, and I'm worried that I'm going to get left behind and that my hedges are just going to cost me money if the market rallies here. Any advice?
Well, I don't know how you'd be left behind on a hedge against an asset class. You have more money allocated in the asset class than the hedge.
I think that's the big takeaway there.
I don't understand the premise of the question, given the fact that nobody would be left behind. You have a hedge to hedge volatility. It's like you have car insurance and you didn't get in a car wreck that month and you want to get your money back for not getting in a car wreck that month. You still have your car, you still have your life, you still have the asset class. Does that make sense?
No, it does to me. But I think it goes to individuals that buy put options to protect when you get upward movement. I think psychologically, I think there is a, oh my goodness, I'm just wasting money again if I buy a put. Like I
if you
should
buy
never
a put in the short term to cover a short term situation and the end of the world didn't happen in the short term, yeah, you did lose that money. Yeah. So the question is, what are you hedging? Are you hedging short term? Are you hedging long term? And
Yeah.
if you're going to add a hedge, what's the plan to remove the hedge? And if it isn't, when it breaks out of resistance, I don't know what it is.
Yeah,
So,
and I think this is where technical development, and one of the reasons we highlight technical development. If you trade
I
sideways,
also
you
don't
set up.
think hedging in the short term, unless it's an earnings report, is a smart way to go about it, unless you're talking about the covered call. And so, like for me, and I did a delta weighting conversation in the coaches show this Tuesday. I was in Master Trader 2 weeks ago talking about these conditions. I've been in the lounge every single day. How we talk about hedging long term in these environments was not really adding short term put options. It was selling short term call options to take advantage of the volatility to bring in cash flow. And if you wanted to take cash flow and park it into longer term out of the money put options as a form of a hedge, that was a good way to go about that. But if you're hedging short term, you're asking to lose the hedge. Like that's you want to lose the hedge. That's what you want to do. You want to lose the hedge, quite frankly. You don't want to buy life insurance and then have to execute your life insurance. You don't want to buy, hurricane insurance and have to execute your hurricane insurance. And so if you bought insurance on an asset class in the financial world and it didn't die, it's the same philosophy. You don't worry about your hedge. You're happy that your asset class is fine. And so for me, in these environments, the initial thing is to write cover calls, take advantage of the volatility, bring in cash flow, offset directional risk that way. And then in reducing those hedges, you would basically be tracking that the same way you track any other cover call conversation. What is your net liquidation value against your asset class, against the call option you sold? How when it breaks back up above the strike sold, what is your management plan there? And so I would say if you don't know how to do that, come to Tackle Trading, get the Tackle 25, learn covered calls, and learn how to manage. On the hedging side of the equation, again, are they buying short-term hedges to cover short-term volatility? Are they doing longer-term hedges here? We haven't really talked a lot about short-term hedges other than callers around earnings, and you pull those off of after earnings, regardless of whatever the price does. So if they're hedging market volatility because they were concerned, and now they're not concerned, then they should pull off the hedge.
Yeah, I think your coach's show, Matt did a fantastic coach's show on Tuesday night.
You can't answer that question without understanding delta weighting principles.
Delta weighting, Matt, seriously, come to Tackle Trading, sign up for a 15-day free trial. First thing you should do.
Somebody asked me if they should buy health insurance.
Matt did an absolute fantastic class on delta weighting. One of those things that you just can't find by Googling on the web.
Is your delta where you want it to be with the hedge on? Then you don't do anything with the hedge.
Yeah. So I seriously,
that's a portfolio delta weighting conversation. I would strongly encourage anybody to review last week's coaches show on that conversation. But to me, I would alleviate covered calls through the net liquid, through the difference between extrinsic value and intrinsic value, and every single way we teach people how to manage covered calls. On the put side, if you bought insurance on the short term, that's you're just going to lose money the same way you lose money on insurance in every aspect of your life, every single month almost.
I have one more question before
I would encourage you to learn how to do longer term hedges than shorter term, though.
Yes, absolutely. And seriously, we talk hedging all the time in our traders lounge, and when to do it, how to do it. We do shows on it. It is just managing your portfolio. It's a very important skill set, one that we prioritize in our community very much.
I really struggle. My analytical mindset really struggles with the I'm going to be left behind because my hedges don't work. I'm trying to figure out how mathematical.
See, your analytical mind has a hard time. I understand that completely because I'm very, I understand just the emotions behind the question very, very, very much.
I get it. But if you're hedging, you still have a heck of a lot more money in the asset class. That's all I'm saying. Like,
And that's the key point. I got one more question before we wrap up our podcast, Matt. I have heard you talk about the 1 hour chart being the dominant chart for some time now, and what this question is referring to is, Matt, in whether it is the tackle today, the morning, top 5 stories Matt does every day, or within the lounge, or in our, anywhere on our Discord channel, Matt has been anchoring against the 1 hour chart. He's been talking about it being the dominant trend. He's been talking about why. And the question is, you've been talking about it being the 1 hour, being the dominant trend. What is it going to take for that to no longer be the dominant trend? I think this is an excellent question, Matt.
Number one, we have to see some alleviation on the macro side of the equation. We are seeing that. You can couple that with the VIX coming back down underneath 20. We're currently at 25. Getting underneath 30 was an important part of that equation. But for me, it's the daily structure has to be more consistent than it currently is. And when you lack complete daily structure on a chart, and I'll just go back a couple weeks ago, when you broke that 550 level a couple weeks ago, you left the station from a logical perspective from technical analysis. It was all volatility. It was all algorithms. There was no support to be had. And legitimately, the only support level that is underneath there is if you go to the spiders, is like at 500 significant whole number, 495 hypothetical minor pivot point, and then a massive support level between 465 and 480 on the S&P 500 ETF. But you had this pocket of nothingness, like legitimately nothingness underneath 550. And that's one of the reasons why we've seen so much sensitivity to price action recently, is because there was no daily structure. And I wrote about this in the newsletter quite a bit, but there was no daily structure to the chart. And when the chart lost daily structure, you're going to have to see a support build. Now, the 1 hour time frame was chiefly important before that. I'm just kind of talking what would it take to remove that. And so from that point on, it was all intraday analysis with an understanding of the major zones on the daily chart. Well, Mark, if we break out of this level bear stop out analysis and you start to see a marketplace that is not pricing in either the end all of all things or the be all of all things, then you know what, we can get back to a little bit more structure outside the intraday. And so for me, I think last week was an important part of that puzzle. The increase in support, us talking about the consistency of the intraday levels. I mean, when you look at it on an hourly chart, pretty consistent last week, Chucky. Last 4 trading sessions of the day or the week, pretty consistent. And now you worked up into resistance, pretty consistent. A little bit of pullback, pretty consistent. And so the most consistency I've seen on charts is the intraday read. That is starting to change a little bit. And I think over the next couple weeks, and honestly, it's the earnings conversation and the economic conversation more so this week than even the tariff conversation, in my opinion. But over the next, I would say 10 days or so, I think we'll start to see a lot more structure coming back to a lot of charts, not just the S&P 500. So still in volatility playbook, and we'll talk about it in the lounge every single day. We're in the lounge, but as long as we're in volatility playbook, part of that is cutting position size and cutting time frames. And so I'm going to continue to do that.
Yeah, what I've enjoyed, and my brother is a cold-blooded trader. He has been asked multiple times the last couple of weeks, "Are you bullish? Are you bearish?" And he's like, "This is the stupid question. What's the intraday chart doing?" And he's nicer than that. He's like, he doesn't say, "Oh, that's a stupid question."
I
don't
believe there are stupid questions.
Yes, but like people are like, "Are you bullish or bearish?" Because people want those easy answers, and Matt's like, "Well, I don't care because I'm going to go where the
I won't just provide an easy answer because somebody wants to hear it. No, I won't do that."
And he's like, "What's the intraday?" There's intraday opportunities on both sides, right? And he's been very open. Like, this is a great day traders market. He's like, that's where you take advantage of it. The other questions will answer themselves over time. And
Well,
this is why, like, being
there are
like,
two
as
things. One is to start identifying stocks. The conversation in the last 2 weeks at Tackle Trading has been very simple. Start identifying stocks you want to invest in long term. Number two, while that occurs, we focus on the intraday side of the equation. And so I understand the question, I understand the concern, but at the end of the day, it is our job to find the trend. That is our job. It is our job to find the trend. And if the trend is not on the daily chart, then it has to be on the intraday side of the equation. And well, the intraday, I say this is a tell's old as time. As the day traders get consistent, then the swing traders get more confidence. The day traders right now are consistent. They are. And the swing traders are starting to get a little bit antsy. They are. I can tell you, the Delta Dog's getting a little bit anxious out there. And so, but we're still early there. It's been a little bit of control. We need to see a little bit more control. And honestly, Mark, you get a breakout that gets confirmed that then establishes a higher level of support after you break out a bear stop out. Like that's to me, like, and I'll just end on this, Mark. When you look at those case studies of years gone by, that market correction type scenarios, well, when you had this bear stop out pattern here in the pandemic, you broke out of that. And that was a trader's conversation. But it's not like that bear stop out was the end all be all of the bullish uptrend. Just a month later, you went through about 3 weeks of consolidation before you eventually broke through with a beautiful high base against the 200-day moving average. And it was at that point where it was the most beautiful trading signal of all time. And then you had that snap back down into the 200. It got double tapped against the 200. And after that, it was off to the races. You go back in 2018, Mark, same type of thing. You had a nice little pattern, broke out of the 20, bear stop out analysis, had a good trader situation for about, a week and a half until you started consolidating here. And then once you consolidated, you broke out of that consolidation, ran pretty close to the 200, then you broke out of the 200, snapped back around the 200, then you were off to the races. And so when you're looking at those case studies, Mark, everybody always wants to tell me what to buy right now, right this very second, right? Well, let the data do the talking. We're in the very, very, very early stages of recovery. And so if we're going to see bear stop out work out, if we're going to see that next elevated support level, all of these are improving conditions. There's no doubt about that. But there's no one end all be all answer of when to get back in the market if you get out. That's why I always say in these times, it's better to write a covered call than to go to cash.
Listen, Matt, I thought you were on fire this podcast. Send us out.
Yeah, if you love tackle trading and you want to become a member of our team Tackle at Tackle Trading, you can go sign up for a free trial of Tackle Trading's Pro membership right now over there at tackletrading.com. You can hit the link in the description below as well. Also, if you love the pod, you want to help it out, the best way to help it out is just give us a nice little like and share, put a comment in the comment section, and help us get the visibility of the Trading Justice podcast out there into more eyes and listeners out there as well. So with that said, I hope everybody has a blessed week. Have an amazing trading week as well. And if you need anything from us at Tackle Trading, you can hit us up at team@Tackle Trading, or obviously in our Tackle Trading Discord as well.
Have a great week, everyone.